Hello YouTube, welcome to my channel, and this is a simple guide to trade options. This is going to be the part 5, and it's going to be using the KISS method, the keep it simple stupid method. So we're going to try to keep it simple so that we can follow this strategy. And the first thing that we need to understand is that we need to trade small. Always start with just one lot. Doesn't matter the size of your account, start with one lot if you're learning, because that's how you're gonna make mistakes, and it's better to do mistakes with small amount of money. So if you can't sleep because of a trade, then you're trading too big. Always start very small. So let's say that you have a $5,000 account and you're doing all your trade as defined risk. Then as your account gets bigger, you just start widening the strikes, the width of the strikes. So instead of a $5 wide, you start doing $10 wide or $20 wide until you get to trade a strangle or a naked trade, and then you can continue to do other trades until you can get to more than one lot. Another thing that you can do, if your account still keep getting bigger and bigger, then eventually you can start trading futures if you want. But for futures, you need at least a 6-figure account, I will say. So the next part will be the capital allocation. It will be between 25 and 50%. And what that means is that if I have a $10,000 account, 50% of 10,000 will be $5,000 will be allocated in trades, and the other $5,000 will be just in cash. And this is a graph that the guys of Tasty Trade made. And as you can see, using 50% of your portfolio of your allocation and doing strangles will have great results. But as you can see, also a lot of volatility. So your portfolio will be more volatile, and it may have margin issues in extreme events, like for example in 2009. And as you can see, every time that there's been like a big move, the move is way bigger when we're using 50%. And another interesting thing is that when we use 25%, then we're basically equaling the performance of the SPY. So if you use more than 25%, then you're gonna beat the SPY. But at the same time, you can see that those portfolios are less volatile too. So when it goes down, it doesn't go as low as the SPY alone, and it's more of a straight line or closer to a straight line, or smoother line, I should say, than the SPY. So what can we do to try and maximize so that we can make more money? Then we can scale into positions. So a strategy that we can do is, for example, when the VIX is greater than 20, then we can have an allocation of more than 50%, like 60% or so. Between 15 and 20, then around 50%. And when the VIX is low, under 10, then around 30%, for example. That will be one type of strategy that you can do, depending on what you want to accomplish and the risk that you want to take. So the next part will be the diversification, how we can diversify our risk. And we can diversify different ways, but the first part will be using different ETFs. ETFs are exchange traded funds. For example, these are a couple of the equity funds. The S&P 500 will be SPY. The IA is the Dow. The Nasdaq is the QQQ, and the Russell IWM. As you can see, all these ETFs have a very high correlation of positive 0.9. That means that for every dollar that the SPY moves, those other ETFs move 0.9, 0.9, and 0.8. But when the VIX is over 20, it usually is when we are in a down move, then all of them goes +1. So it's basically the same trade. So don't think of diversification. If you have three different strangles in those trades, it's basically the same trade. So you treat them as just one. So what we can do, we can use other ETFs that have less correlation. For example, we can use gold, which is GLD, silver, which is SLV. Those are metals, and I treat those two as the same trade because between them they are highly correlated. But as you can see, between those two and the S&P 500, the correlation is 0 in GLD and plus 0.2 in SLV. High correlation, I will say, is above 0.5, 0.6 will be a high correlation. For example, as you can see on crude oil, which is USO, when the VIX is low or things are calmer, there are not as much correlation, just 0.3. But when things start to get more movement in the SPY, like for example right now, then the correlation goes over 0.6. So be mindful when you have trades in those markets. Also, we can go to the currencies. So we talk first metals, gold and silver, oil, which is energy. I counted that as energy, and then currencies. For example, the euro and the pound, FXC and FXB. As you can see, the all-day correlation is very low, and even when the things go, the VIX go over 20, it's still relatively low. And lastly, bonds, which is TLT, also have a kind of a low correlation. In this case, is a negative correlation. So what it means is that when the SPY goes up $1, the usually TLT will be down 0.4, 40 cents basically. So what else can we do to keep it simple? The days to expiration that we make the trades will be usually 45 days. So between 40 and 60 days usually. You can do more days, and that's another way to diversify. So have a different time, diversify with time, diversify with positions. Also, you can diversify with strategies if you want. And lastly, trade management. This will be either closing it when we get to 21 days or when we have 50% of the credit received. This is another graph from Tasty Trade. As we can see, if we manage earlier, which is at 21 days, or manage at 50%, those are basically equal, and both will beat the S&P 500. But if we combine these strategies, then we beat it by quite a lot. And that also is telling us that instead of the 25% to equal the SPY, we only require 16% of the capital allocation to match the SPY performance. So that will be 8 to 9% lower than either managing earlier or managing winner, which is great. So let's go and discuss more details. So this is the portfolio. This is a $5,000 portfolio, and this is the trade that we made. As we can see, we're actually making money. We're up $19 for the year, and we're making $18 in that trade, and the other ones we're making either $1 or $4, and we're losing $4 in this other one. So let's talk first on the diversification. As you can see, TLT is bonds, as we discussed. FXY is from currency. This is the yen, Japanese yen, and the Qs is the Nasdaq, and XLU is also from equities, but it doesn't have that much correlation, and I can show it here. If I let's go here to my positions. If we compare, for example, Q's the correlation with SPY, we can see it's pretty high, 0.86. XLU with SPY is negative 0.11, and TLT negative 0.32, and FXY negative 0.29. So it's very in that particular portfolio, it is very diversified. In another portfolio that I have here, so this is one account out of 3. These are other positions that I have in other accounts with futures. For example, these are bonds. As you can see, this is similar to the TLT, but just a bigger trade. SI is silver and gold, so I treat these two as metals, as I say. ES is the S&P 500. CL is oil, and this is oil also, so both are similar trades. The difference is the expiration. So one the expiring in April and in March, so the diversification is in terms of time in this particular trade. This is the yen, the Japanese yen. This is the euro futures and the British pound futures. So these 3, I count them as currency trades. So in terms of keep it simple and the managing very easily, what I do is I keep it here in the positions, and as soon as I made these trades, I don't need to be in front of the computer every time. I just need to take a look at like 5 minutes or so. I can click here and open all the positions, and I can see the different dates that they have. So these have 62 days to expire, 62 days, 34 and 34 days. And what I do is I can put it here in order, the one that have less days, and when it gets to 21 days, I close it. Doesn't matter what if I'm winning or losing, I will close it when it gets to 21 days. But if it gets to my target before, then I still close it. The way I do it, if I have working orders already, let me cancel this working order. The way to do it is to let's say I want to put a good to cancel order when it gets to 50%. I just click every leg, which is gonna be the trade. I right click, close position, but I can click here close profit percentage, 50%. I can move here to 45, 50, 55. When it's at 50%, I click here, and it gives me the review and send. Good until cancel, so I don't have to do this again. Review and send, and that's it. It's gonna be a working order for the next trading session, and all the other ones already have those working orders. So I just need to hop on once, see if there's something that I need to do. The 21 days, then I can close it, or I can get it's a way to make it very simple, so I am very efficient with my time. I don't have to spend hours in front of the computer. I can do other things and enjoy life, and don't need to be watching if I'm winning today, losing today. I still like to I open it every day and look at it because I like to trade, but I am not trading every single day. So hopefully this was interesting, and it's gonna help you in your trading career, or at least to give you ideas how to trade. If you have any questions, just put it in the comments. I'll do my best to answer as soon as possible, and don't forget to like the video and subscribe and hit the bell if you want to get notifications. Thank you and take care.